Ladies and gentlemen, boys and girls, welcome to the show. I am your host with the most, Chase Money. Yes, last name Money. And what a day, what a week, what a year. Maybe we should all go on a holiday. It was crazy. In fact, you know what? This week and this year was actually going all right up until Thursday. And then things started to fall apart, and we're going to talk about why. We're going to talk about the markets today, everything that happened this week, everything that transpired, and what it means for you and your portfolios. We're going to look at some of the biggest winners, some of the biggest losers, and what this move means in the context of the market and what you should be doing next. We're going to talk about billionaires. We're going to talk about Warren Buffett and some of the big banks and what they expect from the economy in the next 12 months. We're also going to look at some of the ramifications of Trump's tariffs. Everything is tied to Trump's tariffs and his trade policy. And we're going to talk about what it means, some of the biggest news stories, and then we're also going to look at potentially some stocks that are in the buy zone right now. But before we get to that, guys, if you all could please go ahead, subscribe, like this video, that would be much appreciated. Now let's go ahead and quickly recap the market today. A pretty vicious day. We had every single sector in the red, a complete liquidation. There were no winners. Software, tech, IT, hardware, utilities, even the defensive assets were sold off. A complete liquidation. We saw the dollar was bid up today, and that means one of two things. The market was just rotating into the dollar, into cash. They see that as the safest option. We even saw stuff like gold down today, with the S&P 500 down 8% for the week, a brutal week, and actually peak to trough. You're looking at about a 10% move, peak to trough. We actually rallied into Liberation Day, and then got tariffs that were significantly harsher than expected. The effective US tariff rate around about the 20 to 29% mark. I know that's a big range, but that's what we got right now. Different sources telling us different things. But the truth is somewhere in the middle, a very high effective tariff rate. We were looking for an effective tariff rate of about 15, anywhere from 10 to 15%. We beat expectations, and the market has to re-rate because we are seeing a total restructuring of global trade policy. And essentially what the Trump administration here is trying to do is they're going to replace income and corporate taxes with tariffs in the context of a smaller government while strengthening America's domestic base. I mean, when you just put it like that on paper, it seems great, but the market doesn't really like what's happening because restructuring global trade, that has major ramifications, and it doesn't happen overnight. Now, looking at some of the big winners today, or I should say losers, there were no winners. Apple fell 7%. So look, this was reminiscent of the mega caps. Look at value stocks. I like to look at Evolution as a value stock, pays a high dividend, buy back shares, low valuation, still growing, down 4%, brutal day. High beta stuff like Robinhood down, 9% for the day. Even Coca-Cola, as a consumer staple stock, has like very defensive characteristics. I'll be drinking Coca-Cola later this afternoon at a party I'm going to. Even in this, I guess, global uncertainty, even Coca-Cola was down 4.4%, and JP Morgan down 8% here on the day. Even banks, and to be honest, stuff like regional banks, stuff like banks as a whole. JP Morgan's more of an investment bank. It does have global exposure, I guess. But yes, even some of the regional banks were down like double digits today. Really goes to show that what we really just saw was capitulation and just a total shunning of risk assets. Today was one of the craziest days we've ever seen. We fell 6%. That was the drop, and one of the biggest single day moves ever. Look, we actually fell more today in the S&P 500 than we did here at 9/11. Absolutely insane. We fell more today than on April 2000 of the dot-com crash, sort of when everything started. So today's move was very, very big, and it probably does lean on the fact that we will go lower. In fact, the only other two times we saw bigger single day moves was actually at the GFC in October, and then like COVID, during that March period right there. Other than that, this was a pretty big move, and billionaires lost a ton of money. About $250 billion in total net worth has been evaporated year to date. Most of that happening in the last couple of days, except for Warren Buffett. What an absolute legend, gaining 12%. Berkshire Hathaway acting very, very strongly. That cash pile really opened Buffett, and everybody was asking, why is he building a cash pile? Here we are, and Buffett looks like a genius. Again, now there was this video going around. I'm going to play it right now.
Trump is crashing the stock market by 20% this month, but he's doing it on purpose. And this is why Warren Buffett just said Trump is making the best economic moves he's seen in over 50 years. Now, here's the secret game he's playing, and it could make you rich. So why is he doing this? To push cash into treasuries, which forces the Fed to slash interest rates in May, and those lower rates give the Fed the ability to refinance trillions of debt very inexpensively. It also weakens the dollar and drops mortgage rates. Now, it's a wild chess move, but it's working. Now, you're probably wondering, what about his tariffs? Well, I'll tell you, it's a genius play. It actually forces companies to build here to dodge them. It also forces farmers to sell more of their products here in the U.S. to bring grocery prices way down. We've already seen this with eggs. Now, remember, 94% of all stocks are owned only by 8% of Americans. So Trump, he's taking from the rich short term and handing it to the middle class through lower prices.
So Donald Trump came out, reposted that video, and then Berkshire Hathaway said there are reports currently circulating on social media, including Twitter, Facebook, and TikTok, regarding comments allegedly made by Warren E. Buffett. All such reports are fake. So what you saw there, Warren Buffett didn't say any of that. Warren Buffett, I believe, has actually come out and said that he's not in contact with anyone from the administration, especially as it pertains to his AGM, which is on the 3rd of May. Now, JP Morgan came out and they made statements too. They said there will be blood. Can you believe that? That's the headline they led with. There will be blood. JP Morgan warns of a 60% global recession odds under Donald Trump's tariff situation. Now, and JP Morgan pretty much came out and said the reason why they see this is because growth will slow down tangibly, the unemployment rate will tick up, everything will get more expensive due to tariffs, and this is just a really bad way to go about restructuring the overall American economy, which has worked very, very well over the last 50 years. So JP Morgan don't like what Trump's doing. They see a 60% odds of recession, which probably means they see the likelihood of a recession occurring. A recession is defined as 2 quarters of negative GDP growth, and they see that occurring in the 3rd and 4th quarter of 2025. Now, the reason why recessions are terrible, guys, is because during recessions, S&P 500 EPS falls by a median percentage of about 13%. Generally speaking, the S&P 500 tracks earnings very, very closely. And when you have earnings drop by that amount, you're going to see a massive move in anticipation of this. And this is why you have these massive swings, especially with where valuations are right now in the S&P 500. You can see absolutely magnified moves as a result. And because of everything we've seen, Trump's tariffs, the uncertainty, several initial public offerings have been put on hold as investors grapple with sharp sell-offs across global markets. Ticket platform StubHub has delayed its roadshow presentation slated for next week, according to reports from Wall Street Journal. Meanwhile, digital platforms company Klarna, fintech company Chime, and adtech company MNTN has reportedly the pause button on going public. Absolutely insane. I mean, if all of this happened 3 or 4 weeks earlier, we may not have even seen a CoreWeave IPO. So this is absolutely crazy. We also got some news from Nintendo. GameStop and Nintendo came out and said pre-orders for the Nintendo 2 Switch in the US will not start until April 9th. In order to assess the potential impact of tariffs and evolving market conditions, Nintendo will update timing at a later date. The launch date of 5th June 2025 is unchanged. GameStop will continue to work closely with Nintendo and provide updates as soon as more information becomes available. Stay tuned for further details. So, look, we are starting to see a lot of moving parts fall back, IPOs pushed back, launches pushed back, and expect more of the same as this progresses if we don't come to a viable solution. And if markets and countries continue to retaliate, expect much more of the same, and it's going to be very widespread. Now, TikTok got another life extension. Trump extended its deadline for the TikTok sale to a non-Chinese buyer to avoid a ban. In a post on his social media Truth platform, he said, "My administration has been working very hard on a deal to save TikTok, and we have made tremendous progress. The deal requires more work to ensure all necessary approvals are signed, which is why I'm signing an executive order to keep TikTok up and running for an additional 75 days. So there'll be another 75 days to get this up and running, and hopefully we can get a buy within that 75-day time period. But obviously there are delays. Not really sure why, but this is the situation where we are. Now, all of the commotion we saw, I really do view this as a buying opportunity. And I think it'd be great to hop into a couple of defensive names, particularly in the healthcare sector. We're going to look at two names. The first one being Hims and Her Health. Now, I've been looking at this stock quite a while because the fundamentals are very, very attractive and the growth profile is attractive as well. If you actually just go here to the forecasts, you can actually see that the stock is projected to grow its earnings very, very strongly over the next couple of years. Now, obviously, that may be revised down thanks to Trump's tariffs. We do know that pharmaceuticals don't have tariffs on them just yet, but they will be coming. And that is obviously going to have top line and bottom line tangibly. That being said, Hims has performed very, very well over the last year, but not without a lot of volatility. Had you bought it this time last year, you'd be up 67% and it would have reached highs of $68. Absolutely insane. Looking at the financials, the company is good. Absolutely. They're just printing cash right now, looking at $1.4 billion in revenue. And they actually have some really good margins. Look at how these margins have expanded to a 14.18% free cash flow margin, nearly 80% gross margins, and a 4% operating margin. So you can see that with a very low operating margin and profit margin, they have a ton of capital expenditures. They're piling into the market, which obviously gets written back and added back free cash flow statement. So that is one risk right there, that they got very low operating margins and profit margins, but fairly stable free cash flow margins. If we go to the balance sheet, it's just fantastic. They have $300 million in cash and short-term investments. And then if you scroll down to the total amount of debt they have, only 11 million. So it's absolutely negligible. So the company is completely not at risk of solvency, and they are growing earnings in a very, very robust way. If we do look at some of its valuation metrics, you can see it trades on a forward PE of 40. So it looks very expensive on an earnings basis. But remember what I said with the operating income margin, it's very, very low because of depreciation, amortization, and that type of stuff. But the free cash flow margin looked far better, trading at 26 times as per yesterday's close. If we then go down here, you could see return on equity of 30%, return of invested capital of 9%, then return on capital employed 13.6%. We're looking at a free cash flow yield of 3.63%, and they are diluting their shareholders as of right now. What are the returns we can expect from him? So assuming 20% earnings growth through 2029, a revenue growth, to 3.6 billion, assuming a 17% free cash flow margin, so pretty much stable margins. We get free cash flow estimates 625 at 2029. That's well below consensus at the moment. You look at an EV to free cash flow of 20 times. You get the enterprise value, subtract the net debt, and then you have the equity value right there, divided by shares outstanding. Shares increase 3% every single year over the next 5 years, and you're looking at about a 14.7% return over the next 5 years. Do be aware that the company is actually buying back shares, and I think by 2025, 2026, maybe later this year, early next year, we should actually probably see a situation where buybacks are probably neutral to stock-based compensation, and then from there you could probably see maybe the share count actually declining. In that case, your returns will be significantly better. But the stock closed at $25. We're looking at a $29 to 2029 stock price of $51. So if you are looking for a bit of defense in your portfolio and looking for offensive defense, I guess, something that's growing and can also offer like recurring revenue, and a lot of these individuals, like let's say on their weight loss, they need to constantly take these drugs. Hims is a place that you could look to. If you want more direct exposure to another healthcare company with GLP-1 exposure, I like Novo Nordisk, and this company looks very, very cheap, and it's something that I actually might go ahead and purchase this week. But let's go ahead and have a look. So if you have a look at the last year, it's not been a very good investment, down 50% and probably about 60% from its highs right there of $146. Now, it trades on a market cap $282 billion. It has a 19 PE ratio, a 15 forward PE ratio. So that's very, very attractive. Let's go ahead and look at some of the financials. Now, this is in a Danish krona, 290,000 in revenue. We scroll down to their free cash flow margins. You could see here that they have a 25% cash flow margin that has declined significantly for various reasons, most of it being capital expenditure. They have very, very solid gross margins that have been increasing, operating margins have increasing. So that really goes to show that the operations of the business are unchanged. It's just that when it comes to some of these final line items, we're seeing the unit economics not translate into free cash flow just yet, but they are expanding their infrastructure quite significantly. We can also see right here that when you look at the shares outstanding, they are buying back shares, not at a rapid rate, but at a pretty good rate. And you can also see that the stock was very overvalued here in 2021, 2022, 2023, and they were still buying quite a lot of shares. So I do expect shares buybacks to accelerate over the next couple of years, especially at these depressed valuations. Looking at the balance sheet, they have 26,000, and this is obviously millions, so it would be 26 billion Danish krona in cash and short-term investments. And then we go to the total debt of the company, and they have 84,000 total debt. So look, they do have more debt, but I'm not really worried about their solvency, because if we actually go to their growth metrics, they are growing very, very rapidly, and they are using that debt effectively. Look at this growth. You're looking at 22% growth this year, 17% next year, 10% in 2027. And that's going to directly translate into the bottom line as well. You can see it's trading on a 15 forward multiple, and this isn't even on next 12 months. This is in 2025. We are in April at the moment. We're 1/3 the way through the year. Nearly 1/3, trades at 12 times next year's earnings, 11 times 2027. And this is where the stock looks really, really attractive. Now, the average analyst has an average price target of 141, 126% upside. At the low end, you're looking at 67%. So the average analyst has a strong buy rating on here. No sells, only buy ratings, but there's only 4 analysts that cover this stock. Now, going back to the financials, the reason why I think this company is great, probably a better investment than IMS, even though it's not growing as fast. It is a duopoly with Eli Lilly. It's got a lot of drugs pipeline. Its patents are only set to expire in 2032. And if you actually have a look at some of its ratios, look, 27 EV to free cash flow, the price to earnings ratio of 19, forward price to earnings ratio, like I showed you before, of 15. And we scroll down here. This is what's credible. 80% return on equity, 22% return on assets, 46% return on invested capital. Its efficiency ratios are amazing, and it trades at an earnings yield of nearly 5%, buying back shares. And the icing on the cake, it pays a 2.5% dividend yield. So, while the stock is doing its thing, you can hold it and, just get your quarterly dividend payments, let the management team buy back as much stock as possible, and you just literally get paid to wait while the stock works out, and you're buying a great company, a market leader at a very fair value, and getting a dividend and buybacks out of that. Novo Nordisk is a strong buy in my opinion. And this is why I think so as well. If you actually have a look and forecast the current revenue, forecast that to grow at this growth rate right here. So 21%, 16, and then slowing down to 9, and 8% into 2029. Assuming steady margins of 50%, we're using an EBITDA margin right here, not free cash flow, just because there's a ton of capital expenditure. So we're really just looking at the operating side of the business and what its value is. So if we look at this right here, an EBITDA margin of 50%, right? And its current EV to EBITDA is 14. So very, very cheap in hindsight. And we see some pretty much no margin expansion. We use a 15 multiple of 1,029. We get the enterprise value, subtract the net debt. Then we get the equity value. We get a share price in 2029 after dividing for shares outstanding of $908. Right, then we add the dividend yield of 2.6%, and you're looking at an 18% turn from current levels, assuming these earnings stay in place. And ultimately, what you really want to do is look for visibility in these earnings right here. If we can hit these targets, particularly this target right here, right, the growth into 2025, and then the growth into 2026. If these remain unchanged, right, I think we're going to see some very, very strong momentum in Novo Nordisk. There's a ton of other stuff with regards to the drugs in its pipeline, but Novo Nordisk looking a little bit more attractive than HIMSS, relatively speaking. But HIMSS does have higher growth. And I also do think that Novo, their margins are probably tapped out in terms of EBITDA margins. I don't think they're going to go higher. Maybe we go to like a 51% EBITDA margin. HIMSS, I think HIMSS has the ability to probably take a 16.4% free cash flow margin and maybe even turn that to a 25% free cash flow margin by the end of 2029. That's very, very possible, especially when you look at their line items and their operating cash flow. There's a ton of margin expansion opportunity there that I see. So it really depends. You don't actually have to just buy one. You can just buy both. But both, if you're looking for a defensive opportunity right now with growth built into the stock, I think any one of these is a great buy right now. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.